Hello, everyone. This is Jim Martens, and welcome to our latest edition of Elliott Wave Traders Classroom. I thought in today's edition we'd do something a bit different. I'm going to talk about a subject that's often not talked about, and that's how difficult it is to forecast markets, whether that's a commodity, an energy, equities, whatever. And regardless of the method you use, it's fraught with the potential for error. And in fact, I often talk about or compare success in trading with and analyzing, because that's where it begins, with success of a major league hitter, where hitting 300, meaning being successful 3 times out of 10 attempts, can push you into the Hall of Fame. Forecasting the future is often similar. And success, particularly long-term success, comes down to 1, recognizing the risks, 2, mitigating those risks as much as possible, which means you have to have a methodology that makes sense. We use the wave principle. It helps us identify the trend. It helps us find opportunities to join that trend. It helps us limit risk, and it helps us recognize when a trend may be coming to an end, and then when a trend has been reversed. All of those are necessary to success over the long term. What I wanted to do today is walk you through an old example of dollar-yen. This is from when I used to cover currencies as part of Elliott Wave International's FX team. And just another example of my knowledge has to do with the wave principle, not necessarily being an expert in any asset class. I can't go out and talk to a farmer about crop rotations and yields and etc. I'm an expert in the wave principle, but I apply it to agricultural products, and I've applied it in the past to FX, to fixed income, to energy markets all around the world. Once you know the rules and guidelines, you can move from market to market using those same rules and guidelines. So let's jump into this. You can see the weekly chart of dollar-yen, and the first place you want to start is by asking, what is the trend? And I don't think there's any doubt here. From the lower left side of the chart to the upper right-hand side of the chart, there are wiggles along the way, but the trend is to the upside. And without evidence to the contrary, we would suspect that that trend will continue going forward. I would start there. Now, we haven't applied any wave principle rules or guidelines. This is just simple observation. And when I first look at a chart like this, I see it as basically a rally. Recognizing the wave principle, I see that setback, decline, given its size, as a likely correction, and then the rally continues as anticipated. And during the second half of this rally, you can see every pullback, the one from year 1200 to 12,000 to about 11.5, that looks corrective and was proven so. The next setback after a rally to new high was proven corrective by the new high that followed. So again, now we're putting a little bit of structure in and saying, yes, these setbacks, including the most recent even, looks to that point, looks to be corrective. So let's drill down a bit more and start applying the wave principle. We're going to do so from the low before that last rally attempt. And you can see it's steady. There are setbacks along the way, but they've all proven corrective, of course. If I was trying to count that, it's a difficult count. But what looks clear is the structure of this setback from above 124 to what, about 120 or so. That looks like a three-wave movement. And I'm tempted already to count it as A, expanded flat, B, C. And in fact, that's exactly what I did. So based on our knowledge of the trend of bigger picture, which we've gone through, based on the corrective path of this latest retreat to around 121, this looks like a corrective movement, meaning that larger trend that we identified is still intact. Remember, from an Elliott Wave perspective, three-wave movements are corrective. To take it a step further, from 121, that certainly looks like an impulsive rally. 5 waves. 5-wave movements are typically in the direction of the trend at one larger degree. We already see that trend based on the corrective nature of the setback as to the upside. The rally from near 121 in 5 waves bolsters that assessment, signals the likely resumption of the rally at larger degree. It also suggests that we should probably draw a line, as is shown here, at that low near 121 and call that our line in the sand and anticipate that this rally has resumed from there. That's our risk point. That's our point of ruin, our uncle point, the key level, however you want to refer to it, to limit risk. No surprise, after that impulse rally, market pulled back. Well, that's what we anticipate after an impulse rally. So the market's following expectations. Now, the subsequent rise appears to be in 3 waves. And that's a warning, a bit of a yellow flag. It could be part of a consolidation that suggests perhaps this is a down of a correction. Maybe there's going to be some consolidation in B, maybe a triangle, and then there's going to be a dip to a new short-term low, but not beneath the absolute low near 121. That dip would finish the anticipated corrective correction and set the stage for a resumption of the rally at larger degree. Now let's look at the outcome, because I think, and I hope you agree, our analysis makes sense. We followed the rules and guidelines as they were, what's available to us, particularly on this 3-hour chart, the 3-wave setback, the 5-wave rally, all tell us what should happen. And we've even refined it a bit to say, yeah, even this correction of that rally from 121 could probe a little bit deeper. But again, we have that low to work against with a bullish outlook. Well, as you can see, the market did continue lower, okay, but it made a new low beneath that low near 121, and that was not expected. My point here, again, goes back to that Major League Baseball reference. Batting 300 ultimately results in your induction into the Hall of Fame. It's all about risk management when we bring that over to the business we're in. Even if you're wrong more than you're right, which in my opinion will likely be the case, you have to limit your risk, move out of the way as soon as the market proves you're wrong. When that occurs, reevaluate while on the sideline. Don't reevaluate while the market's ticking against you. Too much pressure in that case. When you're on the right side of the market, you let the trend run, even if there are indications that, if we're talking a bullish example, that the rally is mature. In my opinion, that's not the red flag. It doesn't tell you to stop. It doesn't tell you the top is in place. When we can count 5 waves up in the 5th wave, well, all it tells you is that rally is likely mature. Will it continue? Maybe. Will it roll over? Maybe. But I tend to stay with the trend until there's evidence that a reversal to the downside has occurred. Because, again, we want to maximize as much as we can every success, because it has to overcome the damage done with each failed attempt and add more, so that at the end of the campaign, we're successful. In this case, it did work out, even with what I thought at the time. And even today, years later, you can see this example was way back in 2007. I still don't see the error overall, even recognizing that the dip to a new short-term low was possible, even likely. We were right on that. We were just wrong on the new low beneath that trough near 121. Failure in our efforts is something we rarely talk about. We like to highlight our successes. And that's why I thought it was appropriate to look at the other side of when you find yourself on the wrong side of the market. You can do everything right and still fail. It's simply part of this business. Now, this chart sequence was part of a seminar I used to put on, again, when I was part of the FX team. And this section was titled, "Where Did I Go Wrong?" And the answer to that is, in my opinion, nowhere. I just didn't get the outcome I thought I would get, because nothing is infallible. It's important that you recognize the realities of the market and what we're trying to accomplish in the marketplace. We're forecasting the future, which comes with risk. You have to know those risks before getting involved. You have to make sure those risks are adequate or reasonable for your personal situation. It's one of the reasons here at Elliott Wave International that we don't give trading advice. We offer you analysis, which often covers what's the trend in the market. Where might the market be going? Where shouldn't it go? And from that, you can derive a strategy, and you can determine if the potential opportunity is right for you. None of us can do that. We do not know you. We do not know your financial condition. We don't know your goals, your tolerances for risk, anything else about you. So we do the analysis, and then it's up to you to determine if there's a reasonable opportunity that you might take advantage of. I hope you find today's lesson helpful. It's different, certainly, but I hope you find it helpful. If you have any questions or comments, as always, don't hesitate to contact us. Your questions and comments often is often the reason that we create the next edition to answer your questions. So keep them coming.